Hello, Kurt Jackson, your Safe Money Man here with today's financial question for you. Hey, is your plan to save for retirement more like gambling and less like saving? Seems over the last 40 years or so, there's been quite a cultural shift towards making gambling an acceptable activity. I know when I was a kid many years ago, gambling was one of the deadly sins. And today, millions of folks flock to Las Vegas every year where they lose billions of dollars. If you don't believe me that they lose billions of dollars, who do you think's footing the bill for all those huge casinos? Thinking about how gambling has now become so mainstream made me wonder if that might be why we're so now comfortable with gambling with our life savings and having it 100% at risk in the market. See, I believe that our perspective on investing has changed because American culture changed first. Now, Merriam-Webster's online dictionary provides the following definition of save, and it's a verb, and it's to preserve or guard from injury, destruction, or loss. And this sounds about right. If you were looking for a place to save your money, you'd want to preserve it from loss, right? The definition of invest is listed as invest is a verb, and it's to commit money in order to earn a financial return. It seems the word invest almost implies that your principal will be secure and that you'd receive a gain in addition to your principal. It has a ring of safety to it, doesn't it? Well, now let's look at Webster's definition of gambling. And gamble's a verb, and it's to play a game for money or property, or to bet on an uncertain outcome, or to stake something on a contingency, to take a chance. When we look at the dictionary definition of gamble, we see it's more in line with what our investing culture has come to accept over the last 30 or 40 years. Do you remember what society thought of gambling back in the 50s, 60s, and 70s? It was considered a negative social element and looked upon with distaste. And if you've been to Vegas in the last 10 years, you surely can't miss the fact that it's a retiree's haven. The very people who, when they were growing up, gambling was thought of as an evil, have now made Risk City their #1 travel destination. Not only that, but some of the most popular cable TV shows are televised gambling events. You can watch it on television, you can play it online 24 hours a day. It's in our 21st American century blood. See, the acceptance of gambling represents a definite cultural change and has doubtlessly had an effect on not only the way we invest, but if we invest at all. Strangely enough, back in 1978, Congress enacted a change in the tax code, which enabled much of the change to speculation in our investing culture. See, they amended Section 401k. It took effect in 1980, and then by 1983, more than half of large companies were setting up 401k plans. And halfway through the 1980s, there were less than 8 million people investing in 401ks, and they had about 100 billion invested. By 2006, there were 70 million participants and more than $3 trillion invested. The average American in the 70s wasn't invested in the market, and by 2006, it's a cultural norm. They went from savings in banks to investing in mutual funds just because of the availability? Come on, no they didn't. There's got to be a correlation between our society's acceptance of gambling and the radical flight from safety to speculation. Again, what the heck just happened? Webster says gambling is wagering money or assets on an uncertain outcome. Well, you know what? Tell me the difference between you investing in an uncertain mutual fund market at one of the most turbulent times in our nation's economic history and gambling. What's the difference between the two? Please, someone tell me. There's more. In 1884, Charles Dow began publishing his Dow Jones Averages in the Customer's Afternoon Letter. Well, that was the forerunner of the Wall Street Journal. And in 1896, he changed the name to the Dow Jones Industrial Average, which consisted of 12 industrial stocks. It was a departure from the original 9 railroad stocks and 2 industrial stocks. The first index that contained the rails, as people refer to it, continued to rival the industrials average for the next 20 years. Now, Russell Napier, in his book, The Anatomy of a Bear, tells us the two main indices, the Dow Jones and the Rail Stocks Index, were the two main indices at the turn of the 1900s. Now, during the hard financial times from 1900 to 1914 and the start of World War I, Napier tells us that the government nationalized the railroads. And guess what happened to that stock index? Right, it virtually went away when the government devalued the rail stocks by their takeover. That was a huge alteration in the market. Another event that caused a deviation in the market was the creation of the Federal Reserve in 1914. The Fed was created to make our currency elastic. In other words, to inflate money supply during a recession or depression, the Fed would print more money, tied very loosely to the gold standard, hoping it would grow the economy. That created incredible changes in the financial markets coming out of 1921. So what similarities are to the government involvement during and after the crash of 2008? Well, how about the near nationalization of our banks or the nationalization of the auto industry? And what about most of all of 20% of our economy represented in the healthcare system? How's that for starters? And what changes will these make in the economy, the stock market, and investing culture? If you don't know the answer to these questions, then is it wise to have a large portion of your retirement assets in the market having no idea what will happen? How confident can you be with no protections or without a strategy to minimize your losses? There's a large paradigm shifts in the market created by cultural changes in bear markets is no place to find solid ground. Now look, I'm not saying you should be out of the market during times such as this, but you should have a solid plan to manage risk in accordance to your conservative tolerance. Remember, the question is not how much money you should have in a mutual fund, but how do you manage your risk? If you don't have a good enough answer, then your assets along with your retirement future might end up in like what as many as 96% of retirees currently experience, where they run out of money before they die and they end up asking, what the heck happened? Now, perhaps you're more conservative in your financial thinking and you'd like to find out if there's a better and safer way to build your wealth. Well, you can check out one possibility at www.kjfinancialonline /802 plan /, or you could call Kurt Jackson at 816-582-5532. Hey, thanks for checking in on our video today. Best wishes for your in your financial endeavor.